If you haven't heard about the Tax Cuts and Jobs Act, you may need to check your Wi-Fi connection because there's no shortage of information out there, to the point of it being overwhelming. The legislation impacts everyone, corporations and individuals, and Southfield tax experts Diana Peagler, president of ELE-Peagler, LLC Bookkeeping and Tax Services, and Ellis Liddell, chairman, CEO of ELE Wealth Management, LLC, will help us unpack the entire bill in understandable terms. The first matter to address is whether the new bill has made it easier to do individual taxes.
It depends on the financial status of each individual taxpayer. For corporate America, it was across the board, and their tax rate is 21%, whereas with individuals, there are 7 different tax brackets.
And as a result of the 7 different tax brackets, it helps to determine whether or not you are going to itemize or take a standard deduction. And because the standard deduction is $12,000 for an individual and $24,000 for a married couple filing joint, due to that, most people don't have $24,000 worth of things to itemize. So it's going to really help simplify the tax return.
With a new bill often comes new forms, but these new forms won't be necessary until next year.
Well, this particular Jobs Act and tax cut is effective for tax year 2018. It does not affect 2017 at all. It's business as usual.
Except for corporate America, the tax became automatically implemented upon the signing. So corporate America's tax rate went down, and as it's going to affect them in a positive way, and a number of corporations are actually giving bonuses off the tax savings. So the individuals working for those corporations that chose to give bonuses are going to get a pay raise, as they say. They're going to get an increase in their pay.
Eliminated tax deductions has drawn much interest, with less impact on corporations and a more concentrated effect on individuals.
Well, as we've just stated, corporate America is not directly impacted by this. There are some amendments that are being addressed but have not passed yet. Mainly it's going to affect individuals, and the one particular item that affects the individual the most is the personal exemption allowance. It's been incrementing by $50. It affects every individual on the tax return, including dependents. And next year it would have been $4,100. $4,100 per person on the tax return is gone. In place of that, you have your lower tax brackets, you have a higher standard deduction. The child tax credit is going to be $2,000 per child instead of $1,000. However, it's important to note that the year in which the child turns 17 years of age, that child tax credit goes away.
Projected negative outcomes has created a conundrum with corporations, as some have given raises to their employees in anticipation of the cuts, while others feel that corporations cannot afford the cuts.
In terms of the employees getting bonuses, most employees would rather have a pay raise versus a one-time bonus, but there will potentially be a deficit because of the reduction with the corporate tax rate. And there are many people who are going to benefit from the estate that's been increased from $5 million to $10 million.
Now, let's just look at it from the corporate side. If I pay my employee more money, that employee is going to in turn put more money back into the economy. If the economy is moving, then there's going to be more jobs created, and when you start looking at the long-term effects of it, the deficit should be offset by the spending. Now, if we're encouraging everybody to save everything, then it doesn't work. But unfortunately, everybody's not going to save everything, and human nature is going to dictate that a lot of that money is going to get spent into new cars, new refrigerators, new washers and dryers, and it's going to just keep spinning the economy in the right direction.
Some of the things that are disappointing that will be eliminated: the home equity loan. If you do home improvements and you've taken a loan out to do those home improvements, in 2018 tax year, you can no longer do that. State, local, and property taxes, they have combined those. On your wages, you have withholding for state, and if you live in a city that has a local tax, that tax plus your real estate taxes are being capped at a maximum of $10,000. If someone makes $100,000, they would reach $10,000 very easily, but it's being capped for those 3 items at $10,000.
Whose idea was this?
The United States government, your Senate and House on the federal level, approved this tax bill in December of 2017.
Was it one of those deals done in the middle of the night, late at night?
Well, I understand that there was not a whole lot of input from other political parties.
And not a whole lot of input from the citizens either, right?
0.
Aha. So therefore, this bill could be changing, or the taxes could be changing, amended, changed before the final thing comes out.
Absolutely. People are looking at it right now, and if the political climate changes, potentially this particular tax law could change. Stay tuned.